Welcome. My name is Lindsay, and I am from the Office of Total Rewards. This video will review health savings accounts, known as HSAs, that the University of Rochester offers to eligible employees. So, what is a health savings account? An HSA is a tax-advantaged savings account that allows you to set aside pre-tax dollars via payroll deduction for qualified medical expenses as defined by the IRS. To be eligible to contribute to a health savings account, you must be enrolled in a high deductible health plan, such as the Your HSA Eligible Health Plan. You cannot have any additional medical coverage, including Medicare, and neither you nor your spouse can have a general purpose flexible spending account. You can, however, have a limited purpose flexible spending account, and you cannot be claimed as a tax dependent on someone else's tax return unless it is your spouse. When you enroll in your healthcare plan, either online or by using a form, the eligibility to contribute to an HSA is detailed for you to read and sign off that you are eligible. Having an HSA has many benefits, and not only can it be a way to pay for medical expenses now, but can also be a part of your long-term financial planning. There is no use it or lose it penalty, meaning the balance rolls over year to year and the money is yours to keep, just like a bank account. Your HSA is portable, and this means you keep your HSA if you retire or leave the university, and you can also designate a beneficiary to inherit your account. Our HSA vendors through Excelis and Aetna offer investment options. If you invest your HSA funds, they remain in the investment account, which is similar to an IRA or a 401k. This means that HSAs have the potential for long-term tax-free savings. If your third-party administrator is Excelis, your HSA vendor will be HSA Bank, and if your administrator is Aetna, then your HSA vendor is PayFlex. And lastly, an HSA offers the potential for triple tax savings, as seen in our chart. You make pre-tax payroll contributions or tax-deductible direct contributions into your HSA. The interest earned and any investment earnings are tax-free. And if you use your HSA funds for qualified medical expenses, your distributions are also tax-free. To contribute to an HSA, you must be enrolled in a high deductible health plan as defined by the IRS. The Your HSA Eligible Plan is a qualified high deductible health plan that meets the IRS requirements. You must also meet the IRS HSA eligibility requirements that we reviewed on our previous slide. Once your HSA has been opened, your HSA vendor, either HSA Bank or PayFlex, will mail your HSA credit or debit card to your home. You will also receive a welcome packet with additional information pertaining to your account, as well as instructions on how to activate your HSA card. As long as you remain eligible, you can continue to contribute to your HSA. You can also change your contribution amount at any time throughout the year, as long as your total annual contribution amount is not above the IRS annual maximum. As with any bank account, you only have access to the funds currently in your HSA. So depending on your account balance and your incurred expenses, you can swipe your HSA card at the point of service or pay out of pocket and reimburse yourself later once you have the funds in your HSA. Again, because your HSA is a bank account and you are the account holder, you are responsible for complying with tax reporting requirements each year. As we mentioned on the previous slide, your HSA has an annual maximum contribution as determined by the IRS. This chart shows the maximums for 2020 as they are broken into two categories, single and family. But family also covers any plans that carry a dependent. So for our plans here, if you are employee plus child or children, employee plus spouse or domestic partner, or on the family plan, you would follow the family max. So single max is $3,550, family is $7,100, and then if you are over 55, you are allowed to contribute an additional $1,000 annually. When you elect to contribute to your HSA through your paycheck, these contributions are considered pre-tax payroll contributions. This means each pay period, your HSA contribution will be deducted from your paycheck and deposited into your HSA on the check date. The way your per paycheck contribution amount is determined is by your annual contribution amount being divided by the number of pay periods remaining in the calendar year. You can make post-tax direct contributions into your HSA through your HSA vendor, either HSA Bank or PayFlex. At the end of the year, you would want to claim any direct contributions on your annual tax return to receive the tax deduction. And you want to make sure that if you're doing pre-tax and post-tax contributions, that you are still set up to follow the annual max as determined by the IRS. And if you have an HSA elsewhere, you can transfer those funds into your new HSA and consolidate if you would like. So how can you use your HSA funds? Since your HSA is like a bank account, funds need to accumulate over time through your pre-tax payroll deductions or post-tax contributions. For example, if you are a monthly employee and elected to contribute $1,200 for the entire year, after your first pay period, you will have $100 in your HSA, and those funds are available to you to use. HSAs receive cards, so you may use your card at point of service. And if we're building off the monthly example, if you have $100 in your account and you go to the doctor and it costs $60, then you could use your account and your card to pay for the service. You can use your HSA for any qualified medical expenses that may provide an online bill. The same you would use any credit or debit card to pay a bill online. And lastly, you can reimburse yourself after the point of service. This might be an option if you don't have adequate funds in your HSA or if you choose to pay out of pocket for qualified medical expenses. You can reimburse yourself with an online bank transfer into your personal checking account that you would do with your HSA vendor directly. Remember, for reimbursements, you must save your receipts and your explanation of benefits in case of an IRS audit, since you may be required to show proof that the distributions from your HSA to your personal bank account were for qualified medical expenses. And then for who you can use your HSA on, you are able to use it on for any qualified medical expenses for yourself, your spouse, or domestic partner if tax dependent, and tax dependent children up to age 26. Qualified expense is a term we have used a few times in this video, and there are a couple things to know about what that means. First, qualified expenses are designated and governed by the IRS, and the list below gives an abbreviated list, not all, of the expenses that you can use your HSA for. The full list can be found by looking up publication 502, and this is also available on the Total Rewards website. Next, to use your HSA for a qualified medical expense for yourself, your spouse, or domestic partner, or your qualified tax-dependent child, the expense must be incurred after the effective date of the HSA. So, if you are a new hire and your benefits are effective the first of the following month, that means any expenses as of that date would be eligible to use your HSA towards. And last, it's important to note that if you use your HSA to pay for ineligible expenses, you will have to pay income taxes on the amount in question, as well as 20% penalty tax. If you are age 65 or older or disabled at the time of the withdrawal, you will not have to pay the 20% penalty, but will still need to pay regular income taxes on the amount in question. And just a reminder, the IRS list of qualified medical expenses can be found in publication 502, which is located on our website. Since HSAs are IRS regulated, we put this slide up to review the tax reporting details with your HSA that you can expect. There's Form 1099, Form 5498, Form W-2, and Form 8889. So these are the things you need to be aware of when tax reporting with your HSA. Limited purpose FSAs are another way to put pre-tax money away for qualified medical expenses, but employees are only eligible if they are on the HSA eligible plan and contributing to an HSA. So a limited purpose FSA can be used to pay for qualified vision or dental expenses until you meet your deductible. After you meet your deductible, you can use your limited purpose FSA to reimburse yourself for any qualified medical expenses. And then we have a specific flexible spending account video on our Total Rewards website, which has more details about flexible spending accounts in general, and then specifically more information about how a limited purpose flexible spending account works. So as we get to our last slide, we want to remind you of the resources available to you. So you can visit your HSA vendor's website, and on their website, so that's HSA Bank or PayFlex, you can view your account balance. You can make a contribution or withdrawal. You can view your transaction history, and you can receive your year-to-date account information. And then for additional information regarding IRS rules and regulations pertaining to health savings accounts, we would encourage you to view publication 502, and that's your full list of qualified medical expenses, and IRS publication 969 for information regarding tax filing requirements. And then on the side of your screen, you'll see the vendor information for PayFlex and HSA Bank. And then we also include the LBS information for FSAs for Excellus. And if you are an Aetna member, your HSA and your FSA would be through PayFlex.